Hi guys, this is Ajay and welcome to Accounting with Ajay. So today we are going to discuss about an important concept. I would say it's a concept discussed and used widely. The time value of money. Let's say I promise to give you $1,000 and I give you two options. The first option is that I will give you that $1,000 immediately, today itself. The second option is I will give you that $1,000 exactly after 1 year time from today. So which one would you choose? Obviously you would like to choose the first option, that is receiving the money immediately, wouldn't you? Why do you prefer an immediate cash receipt? There are certain reasons for that, no? The first reason is if you have that money now, you can purchase your preferred items immediately. Let's say you would like to purchase a smart TV. If you have that $1,000, which means $1,000 immediately, you could purchase the TV immediately. Or you need to wait for 1 year. The second reason is sometimes in future the price of the TV could change. It could increase to $1,200 in 1 year time. Then you will not be able to purchase the TV with this $1,000. Which means the purchasing power of this $1,000 could decrease, maybe due to inflation. The third potential reason is, now let's say you have that $1,000 now. Then what you can do is you can deposit that money, or else you can invest that money. By investing that money or depositing that money, you can earn interest or return. If you receive that $1,000 after 1 year time from me, what will happen is you will lose that interest or the return. So you have an opportunity cost here. The opportunity cost is the foregone return or interest. Finally, though I promise to give you $1,000 after 1 year time, sometimes I may not honor my promise. Earlier the better. I may refuse to give you that $1,000. So there is a risk of getting that money after 1 year time. So due to all these reasons, always money has a time value. The money you have today has more value than the same amount of money you are going to have at a point in future. This is called as the time value of money. So let's change the scenario a bit. Let's say now I request that $1,000 from you, and I promise you to return that $1,000 after 1 year time. Now you would think twice before lending me that $1,000, wouldn't you? Because of some obvious reasons. Firstly, if you lend me that $1,000 today, you have to sacrifice your immediate usage of that $1,000, don't you? You could purchase a smart TV with that $1,000 today. But if you give that $1,000 to me, you will not be able to buy that smart TV immediately. Secondly, you could deposit that money in a fixed deposit and earn an interest of maybe $100. But if you give that money to me, you will not be able to earn that interest. Thirdly, when I return that $1,000 after 1 year, the real value of that $1,000 may decrease due to inflation. For example, the price of the smart TV will have been increased to $1,200. So you may not be able to buy that smart TV, which you could buy it for $1,000 today. Finally, and very important, I may default the payment. I may not return the money to you. So you need to bear that risk as well. Because of all these sufferings, you may expect an additional sum of money in addition to that $1,000 after 1 year time when I return that money. Let's say you prefer a 10% return to compensate your sacrifice of today's consumption. Opportunity cost of an alternative investment opportunity, that is to deposit in a fixed deposit, and reduction in the real value of money due to the inflation. And finally, the risk of default payment, that sometimes I may not pay back your money. So for all these reasons, now you are expecting a 10% return. So if you prefer a 10% return, I need to pay back $1,100 to you. That is the initial capital of $1,000 and the return of $100. Therefore, for you, the $1,100 after 1 year has equal value to the today's $1,000. Or in other words, you will be happy to invest $1,000 today if you are going to receive $1,100 or more after 1 year time. So if we interpret this in accounting language, the future value of $1,100 that you are going to receive after 1 year time is equal to the present value of $1,000 for you. How did we calculate the future value of this $1,000? We multiplied that $1,000 by 10%, and that is for 1 year. Then we added the $1,000 with that 10% of that $1,000, that is $100. So if we simplify the calculation, we multiplied that $1,000 by 1 plus the expected return, that is 10%, and to the power 1, that is for 1 year. So the expected future value of a present value, that is the capital or the principal or else the investment amount, is calculated as present value multiplied by 1 plus expected return to the power number of periods. In our case, this is 1 year. Here the expected return is denoted by R, and number of periods, for example in our case it's 1 year, is denoted by N. So if we do the reverse of it, we can calculate the present value of an expected future value. Can't we? So simply we need to divide the future value by 1 plus the expected return to the power of investment period. That is the fraction we use to calculate the future value by multiplying the present value with that fraction. So guys, that is the equation to calculate the present value for a given future value. So let's apply this to our example. If we have a future value of $1,100 and if our expected return is 10%, then what is the present value of that $1,100? We all know. We can calculate it by reversing the equation, by changing the subject to present value from future value. So if we divide the future value of $1,100 by 1 plus 0.1 to the power 1, then we would get $1,000. It is approximately $1,000. That is the present value of $1,100 for us with the expected return of 10%. But we have to note a point here. The present value may vary investors to investors based on their expected return. So the meaning of this $1,000 is that I am ready to invest a maximum amount of $1,000 today with an expected return of 10% to get a return of $1,100 after 1 year time. So if I summarize this calculation today, that is called as year 0 because it is the immediate day of my investment. If I invest $1,000, the present value of that $1,000 will be $1,000 as it is the cash flow happens today with no time differences. and I'm going to receive $1,100 after 1 year. So the present value of that $1,100 is $1,000, as we calculated already. So in this investment, we have a present value of cash outflow of $1,000 and a present value of cash inflow of $1,000. Thus, the net present value of this investment is 0. So the investment has a net present value of 0. Would you accept this project? This is $1 million question, and I expect your answers for this question in the comment section. So we shall summarize the points we discussed today. We started with the time value of money. The amount of money you have now has more value than the amount of money you are going to have at some point in future. This is because of following reasons. Firstly, sacrificing your immediate consumption. Secondly, inflation and reduction in the value or purchasing power of the money you have now. Thirdly, sacrificing of other investment opportunities. Finally, risk of losing the money if it is given away. Then we talked about the way of finding the expected future value for the present value using the given formula. Finally, we reversed the formula and found the equation to calculate the present value for a given future value. So guys, I hope that we are clear with the concept of time value of money and how to calculate the present value of a future cash flow. So please watch the next video for a detailed example to calculate net present value. That's called as NPV. So thank you for watching. See you soon.